So let me welcome everybody here on behalf of PFM Tax, Africa, and to GRA, particularly for their, presence here. We have some people from the academia, apart from the presenters who are UPSA and Legon. We also have Dr. Bopin, who is also here with us. So if I may just acknowledge that. We acknowledge everybody else who has been introduced. So I have a very limited time. So I'll run through some of the slides. I'll take a bit of time, with some of them, particularly the initial ones. What I'll do is, is to go through the mechanics of VAT, hopefully in a very simple manner. VAT, the tax is on top of value addition. So what do we mean by value addition? That's going to be my focus. The people who, or the businesses that create, value and who charge the tax and collect on behalf of GRA. My focus will be on them and how policy impacts them. And then my colleagues will take aspects of the legislation, and other administrative issues. Next. Next, please. Do I control this? Okay, sorry. Okay. So what we have here is a quick snap. We have to put VAT in context. And so the question is the taxes which form, part of the economy. And we are focusing on only the major taxes, So first of all, we have taxes on income and property. And that means taxes that are paid on income, and then if you own property, which is basically income is wages, salaries, allowances. And then also, if you have property, rent, and then capital gains, and then for, there's a personal income tax of this element, which is paid by employees and self-employed persons. And then the second element of that is a corporate income tax. And the corporate income tax is one of the major handles, which we are going to focus on towards the end, of the. So that is the taxes on direct. It's direct because those who earn the income are the ones who account, for the tax. So we'll keep an eye on the corporate income tax, which because of oil, we separate into, corporate income tax, oil, and then non-oil. The Petroleum Revenue Management Act requires that, all revenue from oil sector should be ring-fenced and paid into the petroleum holding funds. So that is. Then the second category is the indirect. So we have direct, indirect, and that is taxes that are paid on goods and services. The first one, obviously, is what we are talking about, the value added tax. And these taxes are added to the price by those who are selling and pay, to GRA. So we use GRA, or for those of us online, whether it's Uganda Revenue Authority, or Kenya Revenue Authority, South Africa, SARS, that's what we're talking about. So we have the VAT. The key word here is neutral. The tax is neutral. So when you consume beer, you pay the tax. Whether the beer is imported or it is produced locally, you pay the tax. So that tax is neutral. It's on both import and export, goods mainly. And then we also have the excise duty, which is also neutral. There was a distinction. One is a general consumption tax, and is supposed to be very broad-based. Excise is punitive, and it's on specific, products only. So even though it's neutral, alcohol, whether it's produced locally or it's imported, you have to pay excise, in addition to VAT, right? The other, element is petroleum, for environmental and other reasons, tobacco, but we do have it on bottled water and the rest, which connotes a bit of luxury, even though these days you cannot say. So that also is neutral, import, export. But the difference with VAT is that it normally has a higher rate, up to 70%, sometimes 80% is added. Then we have the taxes on international trade. We discount exports because it doesn't make us competitive. Cocoa Board collects some export duty in lieu of income tax by all farmers, a bit discriminatory because farm income is exempted. But then that is what is also used for cocoa roast and a few other. It used to go into the budget. It still goes in and out. But it's now known for cocoa roast and others. And then we have the import duty, which is discriminatory. Unlike VAT and excise, it is on only imports. So this is why we say it protects local industries. So if you produce, again, let's go back to spirits, alcohol, right? You pay import duty, right? But the guy producing pays only VAT. It doesn't pay import duty. And therefore, it immediately drives a wedge, between domestic and imports. So this is the context. So you can see why VAT, because VAT is neutral like excise, but it is not selected. It's not selective. Is said to have the broadest, tax base. And this is what makes VAT attractive. It has a revenue goal, a primarily revenue goal. But we do exemptions and things, to, move on. So that is the context. We can go back during question time to look at some of these things. So what we have here is the sales and service tax, which used to exist, as was said in the introduction. Then we have which changed to VAT, and VAT, the one we adopted, is the invoice credit method. We'll see it. So it replaced those two taxes. So one of the questions will be is, if the VAT is replacing service taxes that used to exist, including telephone calls, landlines at the time, then what is the function of communication service tax? Right? Are we going back? So these are some of the policy questions. Why wouldn't it? Could we have just achieved it through an increase in the VAT rate? Is it just a backdoor? Okay. Compared to Get Fund and NHIL, which we would come to, which has seen one of the disruptions in the smooth running. They were collected as if they were VAT. So everything about VAT was just part of Get Fund. Now they are straight levies. So what's the difference? Have they become excise? But they are neutral, right? So they are like excise. And they are also on imports and exports. So what is it? What's the policy goal, in separating them, right? So those are some of the questions which we want to, and then we discuss the political economy. So you see that and then we have VAT flat rate scheme, withholding and others which we will come to. So that will be the scope of our discussion. Sorry, I'm used to it. Let me just focus on. So the VAT project, this was set already, so 1993, and then suspension in 1995. There's an interesting point here which I like to emphasize and will not repeat. The notion that Ghana did not prepare well for the introduction of VAT. No. Ghana's VAT experiment was fully funded by DFID with advice from Crown agents who were at the forefront of many VAT advice, and it took the number 18 to 24 months, 1993 to 1995. So there's more in the political economic question than in the lack of preparation, compared to other African countries. That then it was reintroduced anyway in 1998. The law was 98, but implementation 1999. And then a lot of disruption started, from Get Fund to CST to NHI, VAT flat rate scheme and the rest. So in 2013, we did a revamp. Not VAT in isolation, but all the tax laws, were revamped. Because we were in a service economy, we were in an oil economy, and those taxes were 80s and 90s, so we needed to do something about them. So now let us try and understand this table. If it's value added, what are we talking about? So we are assuming that our economy is made up of an importer who imports raw materials and passes it on to the manufacturer, right? The manufacturer adds his own cost and the profit margin, which is the value added, right? And then passes it on to the wholesaler, who then distributes to retailers. So we use this throughout so that we understand. So if there's a VAT policy decision, it is impacting, of course, in the end, you can have service providers and the rest, right? But let's take all of them to be represented by the retailer or the distribution. So this table is saying that The importer brings in raw materials of 1,000. So you see the next column is 1,000. That's the value that was entered the economy. And this could be a farmer also producing at the farm gate with very minimal, let's say, VAT on their inputs. So they start the value addition, the creation of value. Then you can see that the manufacturer creates as value, that is their own inputs and their profit of 800, right? So immediately the value addition in the economy goes up to 1,800. That is 1,000 plus 800, okay? Then the wholesaler comes in, he takes the 1,800 and adds, 600, and it continues. Retailer takes it. So you see the value added, the total is increasing from 1,000 to 1,800. The difference is the 800. And then if you take the 2,400 and the 1,800, the difference is the 600, right? And similarly. So this is very important because the tax will be imposed at every stage where value is added. That's what gives the name, value added tax. Okay? But we'll explain, as we go along. Now, you can remember the tax is not a tax on production. The tax is a tax on consumption. It's not a tax, even though we are using, businesses to collect. It's not a tax on production. So ideally, you can say, let everybody finish the value addition. Let everybody finish the value addition, and then we collect the tax at the end. And that will be 490 at 17.5%. So because you consider the others as not being selling to consumers, you just wait till the end where they are in touch with the consumer and then you sell. But there's a weakness in focusing on the retail. We know it as the informal sector and others in Ghana. So what do? You can also decide to collect on the value added. You remember 1,000, 17.5 is 175. The person has 800, so his tax is only on the value added 140, and then it goes on. And you get the same 490 at the same price, 32, as if you were collecting it at a single point. This is a text. Any policy intervention that changes these two amounts of money introduces a distortion. And it can be positive or negative, like social intervention. If you want to exempt education, health materials, and the rest, you exempt it from the output VAT, and therefore the price goes down. The revenue also. But if you block, we'll come to it. If you intervene with this, you can end up increasing, the price, right? And the revenue or the tax burden. Okay. So we said the weakness already. The weakness is in the fact that, when you do this, at the end, you are dealing with the informal sector, and all that. Now, so what is the VAT mechanism? The VAT mechanism charges all of these people to impose a tax on the cumulative value that is added. So you have 175, and then, sorry, we move on. So you have 175 on the 1,000. The cumulative value added is 1,800. Okay? But remember, in the 1,800, there is 1,000 on which the tax was collected already. So you give the manufacturer credit. That gives the name invoice credit. So he must show an invoice that he paid. So he doesn't double. You don't double the tax, right? Then on the 2,400, there's 1,000 on which the tax was collected already. There's a 600 on which the tax was collected already. And so you give a credit for the next stage. You give a credit for 175, so you give a credit for 315, right? So that they end up paying the tax on just the value added, as we saw previously. And we achieve the same results. So the strength of this, what we say is that if you don't have an invoice, you cannot claim the credit, right? And therefore, we say the VAT is self-policing, because the one buying is anxious, to get the credit. So they help GRA in making sure that they get, because when GRA comes, GRA will want to see before you take your credit. They want to see that you have an invoice to show that you pay the tax. So they help GRA, right? So when that credit, let's take note, and that's the point with get fund and with all, when that credit that is given, right, is refused, denied, or disrupted because there's no invoice, the businessman is not a philanthropist. What do? If they don't have an invoice or somebody or the officials block the credit, what do? They add it to cost. And so the base will now include the input, the tax on the input which they couldn't claim, a credit. And so this is the difficulty we are having with most of the measures that are being implemented now, right? So when you block the VAT, the VAT which the businessman paid, which used to be Get Fund or NHIL, or when you introduce a new tax, CST, right, and you block input tax credit, or when you introduce even a 3%, which is supposed to be net, yes, but you block that credit, all that credit that is denied will be added to the cost. Will be added to the cost, and therefore it would, what we say, cascade. That's the way we call it. So if you look at, what this exemption, sorry. So we have the extreme case where the credit is, sorry. You can have the extreme case where the credit is denied and the tax increases exponentially because everybody is adding no credit. So they are adding whatever they paid on input. And the tax can go, during question time we can look at it. So you can see the tax can go all the way up to about, the value added can go, including tax, including cost, can go all the way up to about, let's say, instead of 3,000 to 4,000 to 5,000, right? And then the tax keeps multiplying on the tax, and therefore the amount of tax that has to be paid. You can see instead of instead of the 490 that we used to have, this one has increased to 625, right? During question time, we can go through some of these, tables, and this is the extreme case where, they are denied, the tax midstream, and therefore it increases from even 600, it goes up to 823. So anytime the tax goes back into the system, it is blocked, it becomes cost, and then it goes up. And so you will recall that when the Get Fund and the NHIE were excluded from the credits, the first protests came from industry and business. You recall that beer prices went up, cement prices went up. I think it was a public, immediately it was measured, it was implemented. That is because the breweries and the cement factories and the rest were no longer getting the credit. And therefore they were treating the tax they were paying on input. Because they are not consumers, they are businessmen, they were adding it. And therefore the prices all over the country started to go up, right? And the same thing with when you extend the VAT, to wholesalers, the flat rate scheme, and which is a small business scheme, the same way you end up pushing the tax on inputs rather than being a tax on output and giving the credit, so that in the end you have only, you are imposing only a tax of less than 400. You end up sometimes imposing, let me just, the time is going fast, so let me just, exports. We don't want to export our tax. We don't even VAT. So what do? We have something called zero rating. The rate, instead of 17.5%, the rate becomes zero, right? So when the person is exporting, in this case, the wholesaler is exporting to another country, they apply a rate of 0 at the point where they are, and therefore they offset they apply 0, so the output tax, the tax on output, what they are selling, becomes 0. But they are registered, and it's a tax, unlike exemption. So they can claim all the taxes that were paid, right, against that 0. And that's how come GRA, gives a refund to exporters. Right, I think there was something, a flash in the news, GRA can confirm, that even ExxonMobil and others left because of, lack of this credit that was given. There was no confirmation or otherwise, of it. So if businesses don't get, and that is why we set up in the new tax law the tax refund, because all exporters would end up invariably with a refund. Even if they are exporting only part of the part that they are exporting, would end up with a refund. So, and this is a situation where the export is done by a manufacturer, not the wholesaler, and you achieve the same results, right? So, what are some of the policy measures that have been introduced? First of all, I mentioned it. The key one is the communication service tax, and lately, because the NHI, the sanitation tax, right? When they were created into a straight levy and a COVID levy, the input tax, even though they were being collected as though they were VAT, the credit was denied, right? So once it's denied, immediately businesses start, adding it to cost. And therefore, costs go up. It's only excise duties and import duties that are added, in the same, manner. So that is one of the policy effects, and it doesn't make Ghana, competitive either, because some of the costs stick because no invoices are issued, so they stick, and our exports, even in an era of AFCTA, we are adding costs to our exports, right? Because if you look at some of the tables, and we can look at them, you will see that it is stuck, with costs, and therefore, unlike let's say pure VAT, where we used to give credit and even a 0, and therefore the whole of the input tax was refunded to make us competitive. These costs are now being added to exports, and it will harm the economy. We cannot be competitive as the other West African countries, even within West Africa trade, African trade, because Kenya 0 rates. We have a scheme where we have, denied, those credits. We have the VAT flat rate scheme. It's supposed to be 3%. Which small entities were also exempted, from the tax, in the past. The VAT flat rate scheme came and is imposing 3%. The worst thing is that it has now been extended to wholesalers and bigger retailers, right? So it's no longer a small tax scheme. So, and because that also comes with, you can say that the difference between the VAT on input and the VAT on output is approximately 3%. But remember, you are not giving, the wholesaler is now in the middle, and you are not giving a tax credit. So if it sells to somebody a service provider who is registered at the end, they'll pass on the cost. So your margin of 3% doesn't hold. When it was on retail, it was at the end. So you can say, yes, it approximates. But right now it's in the middle, right? And don't forget that you can also have a wholesaler who bought from another retailer, an importer or a manufacturer, or even a manufacturer a wholesaler at 3% and selling to a registered manufacturer. Because there's something that says that logically you should sell to only retailers if you're a wholesaler, right? A manufacturer can buy from a wholesaler. So when you say 3%, you are imposing 3% where it should have been 17%, all right, yes. But no invoice was issued, and therefore it will add to the cost, right? So that is, again, and then the other thing too is that the tax authority seems to, shoot themselves in the foot, because we are saying that small retail schemes are for those who cannot keep records, right? But the wholesaler is big. The normal retailer, wholesaler is big. So why the normal large, retailers, the supermarkets, Melcoms, and the rest, they are large. They can keep records. They have accountants and the rest. So why extend a small business scheme to them? In the first place, it defeats your administration, the administrative purposes, compliance, right? Because they are not, they are supposed to keep records before income tax, but they are keeping the invoices anyway. So why don't they? And then because it's added to cost, it is also, defeating, the purpose objectives. So these are a selection. What we want to establish simply is that any policy that disturbs, the right to input tax credit, because VAT is not a tax on business. VAT is a tax on the consumer. So you hurt both business and the consumer, because as we can see, the prices have gone up when you block, that input tax credit. And by the way, get fund. We hear people saying, yeah, but it's like an exercise and whatever. But we do the political economy. We just heard about Kumi Preko. And let me end on this political economy note. Frankly, the VAT was introduced at 15%. At the time, the sales tax was supposed to have gone up to 17.5%, which is where we are now. After Kumi Preko, it became very difficult to reintroduce it at 15%. So it was introduced at 10%. The VAT was introduced at 10%, right? So, but it was not sustainable. It wasn't supporting the budget, right? That revenue was not supporting, even though it has a broader base, it wasn't supporting the budget. So the then government, let me say NDC, decided to increase to 12.5%, but dedicate, the process to education. Who would oppose education, right? So that's how it came. And that's how come it was collected as if it was a VAT. It is a VAT. So we just look at it as an allocation of a VAT that has been collected already, right, and being dedicated to education, right? Okay, the MPP which opposed, this political economy, which opposed the VAT through Kumi Preko and the rest, also came to power. Remember, 12.5% is not sustainable. So they wanted to increase to 15%. What did they do? Okay, if you dedicated it to education and you did this, we are dedicating it to health insurance. So you have NHI, which was also collected as if it was a VAT, right? So the whole thing was just a VAT which is earmarked to education and health. 17.5% came, but then we had, all the issues as we are having now with very little capital expenditure. So it was devoted to what? Ghana Infrastructure Investment Fund. Who doesn't want infrastructure, right? So I think by separating them, they are neither VAT, neither are they excise. And we have defeated the purpose by just adding up to cost. And if I may just scroll, it's not scrolling, okay, to the end. Now this is the result of what we have. These are the major taxes. And you can see the yellow line, which is the corporate income tax, is beginning to perform where it was far below the VAT. So here we are assuming that, this here we have the corporate income tax, we have the import duty, and then we have the excise duty, and these are the strengths of our revenue system, and they should show a certain consistency. But you can see it's all over, and you can see that corporate income tax is going up. I showed this the previous time. What I've done here for clarity, GRA was asking a question. We didn't have time. What I've done is to assume that the health insurance and the GET fund are still VAT, add it to VAT, and let's see the outcome. The next graph assumes that, okay, if they resemble excise, add it to excise, and you get the same result, right? So we have something called a consolidated VAT and a consolidated excise to represent what we have now. In both cases, it's not even yielding the revenue. Now you can see this goes back to 2002. But you can see it is very high. All the graphs are high up to 2006. And that's rebasing. So because the GDP went up. So rebasing is why it is up. And then when you come to 2013, where the new rebasing also starts, you see that, the taxes stalled and whatever, but we had two additional oil fields, so it cushioned it better than in 2006. So rebasing has an impact. And that's why our tax ratios are low. Right? And that is why we must, on this note, let me say, that is why we must not be disturbing, the quality of our main taxes. If you go to every developing country, it is these 4 taxes or 5 that are the mainstay. If you introduce a tax like ESLA, is excise. If it has an objective, 3 to 5 years, let it go. Temporary import duty, don't add it. What you are doing, if you keep it beyond the period when it's supposed to go, you are only disturbing the import duty, rate. Excise is just disturbing, So all those temporary taxes, the fiscal stabilization, levy which was imposed, what is it? It's a corporate income tax, by name, right? So it's disturbing all these taxes. Yeah, they may have a short-term purpose during a crisis like COVID or global financial crisis, doom so. But when they are over, and especially when you have 2 oil fields, let them go so that you can use them for the next crisis. Thank you very much.
Thank you very much, Mr. Terkper, for that presentation.